Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I am Neeraj Shah. You're watching Indian Open. Let's go straight to the headlines. The US and China put their so-called trade war on hold after China promises to bring down the trade gap. This is development over the weekend, could impact commodities. UltraTech Cement is set to take over Century Textiles cement arm, making it the world's third largest cement manufacturer. The insurance regulator wants the three state-run general insurers to pump in 10,000 crores before it gives its go-ahead for the proposed merger. And H.D. Kumaraswamy is set to take oath as Karnataka Chief Minister after the BJP failed to prove majority on Saturday. Well, good morning to everybody, and let's take stock of what's happening in the markets first before we move to the top stories on First Word. Remember, last week wasn't the prettiest of weeks. The global markets, by and large, shut shop in the negative for the week at large. If you look at what the US markets have done or some of the major markets have done, they didn't have the best of weeks. Flattish week with the negative bias, and it was evident in the way trades on Friday happened as well, and the way our markets have done as well. So if you just look at the US markets, the weekly performance, all of these markets have closed in the negative. For our markets, and we all know what's happened during the week, but let's take stock of what happened on Friday. The market breadth turned negative after just one day of outperformance. Remember, Wednesday, the small cap index ended in the green. Thursday, the market breadth was positive. One was only hoping for that to continue, for the small caps to come back and recover. That didn't happen. So the market breadth got impacted after just one day of outperformance. The expectation that a lot of dealer desks had on Saturday night, at least not the dealer desks really, but dealers that I spoke to, was that because of the Karnataka verdict, there could be some pressure on our markets. The SGX 50 is not indicating that. Maybe the global markets, or maybe it was all taken into account in Friday's session itself. But let's wait and watch if there is some additional pressure that the Karnataka verdict puts. There is absence of nifty results today, though. Keep that in mind. That only key mid-cap names that comes out with numbers, non-nifty name that come out with numbers. So Colgate, Future Retail, Mahanagar Gas are amongst the companies that come out with results today, and we'll be watching out for them. But by and large, no index names, and the globe is an okay place today. I think world over, after this news that has come in the world, we'll now be looking forward to the details of the Fed minutes that come out on Wednesday. Until then, maybe the currency markets and the bond markets might take it easy, but for this morning, the world seems to be an okay place. So despite the Karnataka verdict, which may put pressure, we are likely to start off marginally positive. At least the SGX Nifty seems to be indicating a start which is marginally in the green. And therefore, it becomes all the more important to figure out what stocks are likely to react today. And that is what we need to focus on. So firstly, the UltraTech deal. Almost all brokerages, the UltraTech Century Textiles deal, and we'll talk about that in detail on First Word. But most people say that, or at least Macquarie, Motilal and some of the others are saying that it's an attractive acquisition of Century's cement business. Macquarie's, of course, put an overweight and a target price of 4950 on UltraTech. They believe that acquisition will increase UltraTech cement capacity by 14%. Motilal is saying it gives them a pan-India presence, especially with reference to the eastern markets. And we'll talk more about this with Nikki and Yatin, so I don't want to dwell too much on it, but likely that UltraTech cement might have a positive reaction today. Prabhat Dairy, and the reason I bring this up is while the revenues are up only 7%, the margins have improved. Remember, quarter three, there was a bit of a slam dunk on the numbers of Prabhat Dairy. I think they have turned around the corner. Margins have improved. Net profit is at 18 crores versus a net loss of 2 crores. So the numbers optically look reasonably okay. Remember, it's peer. Parag Milk has been on a roll, has been trading at new highs. These numbers might just renew the confidence that some people have on Prabhat. So let's wait and watch if this one reacts. Sheela Foam, fabulous numbers. Revenues up 15%, but the doubling of margins leading to the profit up 88%. So fabulous numbers. Let's see if this one reacts or no. It's not a cheap stock, but might react. And the reason I bring up Den Networks is that they've narrowed their net losses quite considerably. There were some exceptions, but by and large, the numbers seemed okay. The stocks have been beaten down so much, but certain marquee investors have invested out here as well. Let's wait and watch what happens here. And last but not the least, Fortis Healthcare could well be in news. Now you have one director on the board remaining. That notwithstanding, whether or not the stock reacts duly to this development of a couple of directors moving out remains to be seen. The stock ended, of course, 4.5% lower in trade in Friday's session. The last 1 month, it's been all over the place. However, what will we talk about on First Word today? Well, a bunch of things. Actually, a couple of guests coming in on two important issues. We start off with a conversation with Geoff Lewis of Manulife Asset Management to find out his take on this US and China's decision to bury the hatchet and call truce on the so-called trade war. I repeat this word so-called yet again. We talk about UltraTech, the country's largest cement maker, which has just gotten bigger. What does it mean for the sector as a whole as well? Yatin and Nikki joined in to speak about that. And then H.D. Kumaraswamy may take oath on Wednesday, but are opposition parties treating Saturday's occurrence as a watershed moment to come together? We asked senior journalist A.K. Bhattacharya about the same. Okay, news that happened over the last 12 hours. A truce has been called in the so-called trade war between the US and China, but it may not last if the two countries fail to deliver on vague commitments to rebalance trade. Kathleen Hayes of Bloomberg News has this report first.
A trade negotiation, a trade discussion, if you're not going backwards, if you're not both walking away from the table and you're still trying to make progress, that is progress. And again, Steve Mnuchin, the Treasury Secretary, I should say, made it pretty clear for now they're just going to declare a truce on trade. Here's what he said to Fox News Sunday.
We're putting the trade war on hold. So right now we have agreed to put the tariffs on hold while we try to execute the framework. The president has been very clear since the first meeting with President Xi in Mar-a-Lago that we are going to reduce the trade deficit. We have an agreement with China that they will substantially agree to it.
And let's just remember some of the key elements that were on the table, so to speak, going into last week's talks and following the talks between the U.S. and China teams in Beijing week before last. Yes, broadly speaking, President Trump has said he would like China to cut its trade surplus with the U.S., about $376 billion now, by $200 billion by the year 2020. And please, let's tighten up on intellectual property. Stop stealing U.S. Technical secrets. The threat, of course, is that $150 billion of tariffs on China. Now, Larry Kudlow, who is the head of the National Economic Council, one of Donald Trump's top economic advisors, on Face the Nation today, he was asked about, well, is the tariff threat still there? He basically said, in terms of taking them off the table, I don't think we're there yet. He said tariffs are often part of trade negotiations. So that's what we know for sure so far.
You know, Kathleen, though, are there any actual concrete steps that have been taken?
Well, Liu He, who is Xi Jinping's main economic advisor, also agreed, hey, we're not going to have a trade war right now. Here's what he said. We made very meaningful progress and we agreed on a framework. The framework includes their agreement, the U.S. agreement, to substantially reduce the trade deficit by increasing purchases of goods. Larry Kudlow, again, on Face the Nation, saying, well, this would boost U.S. exports by billions and billions and billions. Let's take a look at the joint statement and see some of the elements that were there. First of all, they agree that the steps will be taken to cut the U.S. trade deficit with China. China will buy more U.S. goods and services. And in fact, they will buy more of the U.S. farm and energy exports. That's important. Both see more trade back and forth in manufactured goods. And they want to put paramount importance on intellectual property. So, again, is that concrete? I wouldn't say it's exactly concrete. In fact, Wilbur Ross, according to Steve Mnuchin, will be going immediately to China to start hammering out the details on many of these issues. But again, I think if we know how trade talks go, we know this is going to take time.
Yeah, it certainly will. Well, what does it mean, this trade relief, as it comes about for the markets, commodities and equities both? Let's ask Geoff Lewis, Senior Asia Strategist, Capital Markets and Strategy Group at Manulife Asset Management. He joins us on the phone line from Hong Kong. Jeff, good morning. Many thanks for taking the time out and speaking to us at Bloomberg Quint. What do you think this means? The markets are not reacting in a big way, but maybe the markets are already taken in the possibilities of this trade war getting extended. Now are the markets believing that this truce and how it works out might also be a long-drawn process, therefore no need to react so strongly right now?
Well, I think markets have not discounted the worst case for a trade war. If you look at their relative resilience this year, they're not down that much. And, as you say, almost a complete lack of response. So I think the markets have not discounted the negatives of trade war. They were always assuming that rationality would prevail, that there would be some kind of agreement, that there would be a sitting down and negotiation of these trade issues between the U.S. and China. So I don't think we're going to see any big market moves on the back of this initially. There was a tick up in the S&P 500 futures. There was a slight increase in yields in the Treasury market. But by and large, no big impact. So what we have here is it's not really an agreement for a trade deal. It's an agreement to sit down and try and negotiate a trade deal. And that's obviously what we've been looking for. These issues are not going to be sorted out in a moment. And focusing more on some of the longer-term issues like intellectual property is quite... is appropriate, I think, rather than just focusing on can we get the U.S.-China bilateral deal down by $200 billion over the next couple of years. That's short term. That would just be a palliative. So the good news is I think that at the end of the day, U.S. and China trade relations could be on a firmer footing. I mean, we could have lanced the boil that's been a contention between them.
Geoff, the fear always was that if the elephants fight, the grass around might get trampled upon a bit. And now, there were two large geopolitical stroke international fears, right? One was a trade war, one was geopolitics. We don't know what will happen with geopolitics, anybody's guess. But with this announcement, do the worst of the fears of an imminent trade war and the impact that it could have on either sides out for now?
Oh, yes, I think so. The fact that there's simply too much for both sides to lose. The two economies are simply too closely interconnected that whatever their differences on politics, whatever their differences in terms of strategic competition, the economic relationship is central, and you can't unpick that. You can't reverse it without causing tremendous damage. And so I think... it's going to take a long time for these negotiations. They're going to probably drop out of sight for a while. And at the end of the day, there will be some compromise agreement. So I think the big risk to the economy was not the direct effects of tariffs on this amount of bilateral trade, which the economic models told us was not going to have a big impact. It was more the general impact on business uncertainty and the likely impact that would have had on investment. So I think it's good news all around. And the global economic background is strong, let's not forget that. And now trade fears have at least been postponed, if not totally diffused.
I mean, until it happens, we will talk about it when it happens. My last question, Geoff, do commodities and particularly oil remain at the mercy of geopolitics as opposed to these trade wars? And therefore, would oil movement be largely determined by what's happening in the Middle East and Aramco and a few other factors as opposed to this?
Well, I think the recent moves up in the oil price have been driven by supply-side factors, by geopolitics. They've surprised people, I think, by how quickly oil has moved up. But don't forget the reduction in inventory imbalance was the most rapid on record, according to Cornerstone Economics last year. And the oil price is supported by the strong growth in the global economy. So I think we've pretty much got a floor under oil at $70 a barrel for the immediate future.
Okay, Geoff, we'll leave it at that. Many thanks for joining in today and giving us that perspective. So Geoff Lewis believes that any fears of a trade war have been postponed for the time being. Until they come, we believe that they're not going to come. Let's wait and watch what happens. Therefore, the markets, none of the equity markets or commodities for that matter, are reacting in any big fashion as of now to this announcement. Let's see if there's a bit of a delayed reaction that comes in during the course of the day. It's an important piece of news for sure. Okay, now let's focus back on the domestic turf. And before we get back to politics, I think one large deal that's happened on Sunday, the country's largest cement maker, is set to get bigger. UltraTech decided to take over Century Textiles cement vertical, adding more than 14 million tons to its capacity. Also helps Century cut down its debt substantially. Yatin is here to tell us what UltraTech gets from this deal. Then Nikki will join in and weigh in on what's led UltraTech to be able to do all these deals that it has managed to do, and why is it that it's outperforming almost everybody. But Yatin, firstly to this deal, what it has been for both the sides actually.
Yeah, so Neeraj, let's talk about the deal contours first. So UltraTech, both of UltraTech and Century are Birla Group companies. Kumar Mangalam Birla is heading both of these companies. The deal is that if you are a shareholder of Century Textiles, so your 8 Century Textiles shares will fetch you 1 share of UltraTech. So essentially 1 share of UltraTech is equal to 8 shares of Century Textiles. Apart from that, UltraTech will be also taking over 3,000 crores worth of debt from the books of Century Textiles, which is related to the cement business. And of course, the merger rationale is to consolidate the group's cement capacity. And with this acquisition, subject to shareholders' approval, of course, we'll have Century Textiles focus to be on the textile and the real estate business. And more importantly, this deal is a big thing for UltraTech because they'll be surpassing 100 million tons per annum capacity. So from 92.5 million tons, they'll be moving to 106 million tons after the acquisition. Of course, they'll be, by virtue of this acquisition, number 3 company of the cement sector in the world. So globally, they will make a footprint. More importantly, what's in for UltraTech, we'll have them operate the Century Textiles cement business more efficiently. The overall presence in the western region and the eastern region for UltraTech moves up significantly. Remember, West has been an important market. West India has been an important market for the entire sector. And, we don't have much of a presence for UltraTech in the eastern markets. So, yeah, their east capacity will move up substantially after this acquisition. So, from close to 12 million ton, they'll move little over 16 million tons in the eastern Indian market. As far as the western markets are concerned, they already have a capacity of close to 21.7 million tons per annum. That will move to a level of 26.5. So, most importantly, the east and west market, wherein the presence for UltraTech is required, they'll probably get that pie moving forward. On the valuation front, as I was mentioning earlier, share swap, a non-cash deal, and debt takeover. The total enterprise value that UltraTech has assigned to the entire transaction is close to 8,621 crores. So essentially, UltraTech is paying a consideration of 8,621 crores to the shareholders of Century Textiles. Roughly, 5,000 crores comes in from equity, which is the issuance of shares, and 3,000 comes in terms of the debt takeover. And if you break that up, the 8,600 crores that I was talking about, close to 8,100 is the EV assigned to the cement plants, and close to 536 crores or roughly 550 crores is assigned towards the grinding unit, which is in West Bengal. So on and on, this converts into EV dollar per ton valuation of 106. Industry average is anywhere between 115, 120. Probably undervaluing cement units of Century Textiles, but they are not as profitable as UltraTech's cement plants are. So probably they could justify that particular valuation.
A quick 30 seconds for somebody who's owning a share of Century Textiles. What should he or she expect today?
Century Textiles might see a negative reaction. That is what the analyst or the street expectation is, because they're simply undervaluing the overall cement business. The few questions you need to ask the UltraTech management is that why such a low valuation, wherein they are bidding more for Birani. When they acquired JP Associates, the valuation was much higher. So why lower valuation assigned to Century Textiles, wherein they were on a turnaround path in terms of the overall profitability and product mix and branding their products. Number 2 is that since the core cash flow business of cement is moving out of Century Textiles, how will they fund the massive scale that they want to reach in real estate? Because the debt is going on, the entire transaction is non-cash in nature. So how will the internal accruals suffice the funding requirement of the real estate business? Paper is doing well, but again, it's there is cyclicality, there is up and down in terms of demand. So these are the few questions we need to ask the management as to how really will this transaction happen. It's a non-cash deal. How will they manage cash flows, and how will they really fund the real estate business, which is long-term in nature? Nothing really has kicked off in the real estate business for Century Textiles. So if I'm a Century Textiles shareholder, I'm essentially left over with textiles, paper, and real estate, not very big in terms of the cash flows for the entire business.
Okay. I think thanks for putting that into perspective. We'll stick to cement though. Let's go across to Nikki, who's drawn up a peer comparison for UltraTech Cement and others. Even while ACC and Ambuja shares have witnessed cuts over 20% this year, UltraTech has shown resilience, arresting declines at just half of that. Nikki, the gap's just growing wider.
Yeah, clearly, just in case, I spoke to many analyst community to understand what's actually going on between UltraTech, ACC and Ambuja, and many of them said that it's actually the higher valuations which have led to the sharp corrections that we've seen through in the month of May. Clearly, UltraTech, ACC and Ambuja have almost doubled their declines as compared to what we have seen for UltraTech. But then if you look at the valuation picture, if that is the case, then UltraTech should have been corrected more than what ACC Ambuja has, because of the kind of valuations that the company is demanding. Look at the price to earning ratio. It's almost 43 times as compared to 20 times that we've seen for ACC and Ambuja. EV to EBITDA is pretty much in line, 15, 11, 16. Again, a higher valuation that we're looking for UltraTech Cement. EV per ton again is for 1 year forward at 205 per ton kind of level, which is way higher than what is seen by ACC as well as Ambuja. So clearly, it's not the valuation. It's actually the underlying picture which is triggering this kind of fall. Now, what do analyst community suggest? If you can pull up the second chart, you would see higher amount of buy which is coming in for UltraTech, where 29 analysts are suggesting buy for this stock. The rating potential though seems to be higher for ACC and Ambuja, but then do bear in mind the fact that the stocks have also corrected more than what UltraTech has corrected in the past. If you look at the three key points, or if I may just say three reasons as to why street or why analyst community is preferring UltraTech as compared to ACC and Ambuja, will be first to begin with will be the large capacity addition that UltraTech has over ACC and Ambuja. If you look at this chart for UltraTech, which is it's significantly zoomed, the blue bars from 66.3 that we've seen in 2016 to 2020, which is on account of both organic as well as inorganic expansion, you will see their capacity going up to 109.4, whereas it remains a minuscule 31.4 for ACC, for Ambuja Cement, and 34.8 for ACC. So you can clearly draw the distinction. The aggressive ambitions that, the strategy that UltraTech has embarked upon clearly is reflecting in this chart. It has gone ahead with the JP deal that's already built in. It has, it has taken over it has also taken over Century Textile Business Cement Division. Binani cement assets are on the way. If you look at the organic expansion plans, where you have, UltraTech is going to add 4 MTPA in Bara, UP in FY19. It's going to add another 3.5 MT in FY20. So it's clearly the mix of organic as well as inorganic. On the other side, you have the stagnant capacity for ACC and Ambuja, probably 1-2 MTPA kind of, organic expansions which are coming in. And also do bear in mind the fact that also we have the shelved merger deal that we saw for ACC Ambuja. That's the clear distinction that we can see. Capacity utilization is another key factor which is actually leading to this kind of show that UltraTech is seeing. Clearly, even after adding capacity, if you look at the chart that we have for capacity utilization for UltraTech, it's going from 66% to 85%. This is after acquiring JP assets. And if you look at that for Ambuja as well as ACC, it's not like a big jump that we're looking at. Last, the price is also also the pan-India presence. Now, with the given kind of addition that the company will bring in, clearly ACC has an edge over UltraTech, Ambuja in terms of the presence, and in terms of ACC, it has got a higher exposure that we've seen for Western, Eastern and Central markets. Now, if you see the pricing scenario of these markets, clearly Eastern and Central regions have seen lesser cuts as compared to all the other regions. This is probably the three defining factors why UltraTech is standing out as compared to ACC and Ambuja.
Okay, Nikki, many thanks for that. So, multiple reasons or three key reasons why UltraTech is doing what it is doing on the bourses, not getting beaten down as much as some of the other peers. Thanks for that, Nikki. On to what is arguably one of the biggest stories over the last 7 odd days. H.D. Kumaraswamy set to take oath as Karnataka Chief Minister on Wednesday. This comes after the BJP failed to prove its majority in the assembly on Saturday. A dejected B.S. Yediyurappa chose to step down before the floor test after the Congress and the JDS managed to keep the flock together. This win was also not lost on other regional leaders like Mamata Banerjee and Chandrababu Naidu, who are treating this as a watershed moment for the opposition to come together. Other satraps like Akhilesh Yadav and Mayawati too have decided to join the bandwagon and turn up for Kumaraswamy's swearing-in ceremony. But is it too early for the regional parties to start celebrating? And will this show of strength on Wednesday just remain a photo op? Let's pose this question to Editorial Director at Business Standard, Mr. A.K. Bhattacharya. Mr. Bhattacharya, thanks so much for taking the time out and speaking with us this early in the morning. Could this be the watershed moment for opposition unity?
Well, it is not a watershed moment, but it is certainly a moment where the regional parties have thought necessary to come together and show their combined strength. Because what happened in Karnataka was a narrative that was not very favorable to the BJP, and this gave a ready-made, a playing ground for the regional parties, and they quickly grabbed their opportunity. Actually, right from 15 May evening, when the election results showed that the BJP cannot form its government on its own, the regional parties actually got together, and the Congress really led the offensive from then onwards until on Saturday. It was a clear regional parties show with the full support and endorsement of the Congress. So you see some mobilization of forces on the regional front, but it's early days yet. You do not know what is that glue that will bind them together, who will be their leader that will lead them at the national level. So there are many ifs and buts, but it's certainly a moment where the regional parties think they must get together and explore the options of putting up a joint fight against the BJP. Certainly the narrative has changed somewhat from BJP's series of wins in various elections, state assembly elections, to a narrative where regional parties have something to mull over, to explore the various options they can examine.
Yeah, I mean, Mr. Bhattacharya, the Congress, while the vote share remained okay, the number of seats won was a very poor show, and despite that, they are coming out smelling like roses out of this. They haven't won, but in that sense, the final outcome seems to be giving Congress a belief that they have won.
Well, the Congress is clearly making the best of a bad situation, and I think this was missing, because Congress, the big question before Congress is whether it will agree to give the regional parties a leading position in an alliance that may be formed at the national level.
True.
Because that will be the key issue. And the regional parties realize that Congress is a weakening force. And therefore, the big issue and the glue that I was talking about will be all about whether Congress concedes some ground to regional parties when it comes to providing leadership at the national level.
Yeah, frankly, they may not be left with much choice either. But my final question to you, Mr. Bhattacharya, is is it too early to say that this provides an alternative of sorts? Until now, the last 4 years, every argument from everybody is that, sure, you may not agree with some of the things that the BJP is doing, but there is the Tina factor. You don't have anybody else. Does this set the stage for a possibility, and a significant possibility, of the voters having somebody else? Or is it just too early to call that?
I think it is certainly an opportunity for the regional parties to explore if there could be regional alliances for a national fight. When I say regional alliances for a national fight, what I mean is this, that a set of regional parties, including the Congress, could get together in different states for the Lok Sabha elections. So it will be a national alliance, but with regional combinations. So that possibility is certainly there now. It all remains how long these groupings remain intact and whether further talks proceed. One key answer you will get today is whether the Congress and the JDS amicably agree on a kind of a common minimum program for running the Karnataka government. That's one. Number two, whether the Deputy Chief Minister is identified without any acrimony or any difference of opinion coming out in the open. So these are two issues. If there is a common minimum program for running the government in Karnataka, or the appointment of Deputy Chief Ministers under this Kumaraswamy government becomes an acrimonious issue. These are the two things that we need to be watchful for,
Okay. Mr. Bhattacharya, really appreciate once again taking this call this early in the morning. Thanks much for being with us. Well, let's see if the markets react a bit to this or not. For now, doesn't seem to be the case. But that's all that we have on First Word today. Later on in the shows, it's all about what the impact of this could be and what is an FI view on the same. Rahul Chadha of Mirae Asset Global Investments would be joining to talk about that. We'll decode the March quarter earnings with Mr. M.S. Unnikrishnan of Thermax, and Gopal Mahadevan of Ashok Leyland will be joining in to talk about that as well. And lastly, what should we expect from the markets as the political environment begins to warm up in the run-up to the 2019 general elections? Tirthankar Patnaik of Mizuho Bank would be joining in to speak about that. For now, we take a break. Full tilt towards the day straight on the other side.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts. कितने plain और simple. Fog scent. Plain और simple white shirt को बना दे special और fashionable. Fog scent. New fashion wear for men.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you. Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Welcome back to Indian Open right here on Bloomberg Quint. It's going to be an interesting morning for more reasons than one. We also have Agam Vakil turning 42.
Yes, actually 45.
45, okay. Many happy returns. Belated wishes for a happy birthday, Agam. Thanks so much. But let's take stock of the Asian markets. They seem to be celebrating your birthday.
Right. Well, we are looking at positive cues coming in, because of the fact that we've had some developments with respect to America and perhaps, staying back when it comes to the trade wars, at least for now. And on the back of that, we are looking at gains in the Nikkei, Shanghai, as well as Hang Seng. Hang Seng specifically up as much as 1.2%. So we're looking at good gains coming through, but that really hasn't trickled down for the SGX Nifty. That's like marginally in the green for now at around 10,623. What does it mean for the derivatives markets, and what cues are we looking at? So when it comes to the Nifty, around 2.3% increase in open interest, not too much to speak for, shorts building in. Bank Nifty, on the other hand, the cut is a little more severe, where the open interest now declining by as much as 5.6%, so longs unwinding. India Volatility Index up as much as 5.5%, above the mark of 14, still not in the danger zone of 15, but it continues to remain within the range of 13.5 to 14.5. Among few other counters that will remain in focus is Balrampur Chini and Reliance Communication. But I'm going to come down to that in a bit. I also want to talk about the way we've seen changes in options. And what we've seen last Friday is, while we've seen unwinding in something like a 10,600 put, we've also seen writing in that same particular put. So that's also the reason why we have seen that drop in the put call ratio. Moving in terms of stocks that we keep keeping an eye on, Balrampur Chini and Reliance Communication, as I was mentioning, they move into the band, so we're expecting restricted trade there. On the other hand, Just Dial moves out of the F&O band. Do remember, Just Dial will announce its earnings today. It was down as much as 6% last Friday. We'll have to wait and watch as to what kind of reactions we see to the earnings. The other stock which will also announce its earnings will be Colgate-Palmolive. It saw fresh longs building in, so a lot of traders taking long positions ahead of its earnings, and SRF seeing a lot of weakness. In fact, 42% increase in open interest even as the stock tumbles by as much over 10%. So keep an eye on that one as well as we move to today's day of trade. On the whole, Neeraj, precarious signs coming in as far as the futures and options space is concerned. Let's see how global events and, of course, the political update that we've had over the weekend pans out for our markets.
For now, seems to be an okay start. But let's pose that question to Amit Khurana. He joins in right now with his thoughts on the fundamentals, the macros, and the politics, and lots more. Amit, good having you. Thanks so much for joining in. Opposing forces at play. The US-China trade war called off. That probably helping the global markets. But the impact of the Karnataka outcome on the markets, if any?
Well, I don't think so, really, that much. Because essentially the markets had built-in expectations of a hung assembly already. So if you look at it in perspective, there is something for everybody to take away from Karnataka elections. The BJP emerged as the single largest party, they just missed the majority mark, so that's all right. They tried forming a government, didn't work out, and they're out. And it will be the Congress-led Congress and JDS which will form the government. So I don't think markets will really be bothered about it too much. But I guess the bigger concern now from here onwards is the deterioration on the macro side that we get to see. The oil price, which is continuously moving up. If you see the last few sessions, almost 10-12 days, they have moved up to record high levels. And this will start percolating down to the inflation data. And that, to my mind, is something that the RBI will have to take note of it eventually. Our base case is that we will not get to see a rate hike in June policy, but the commentary will be very, very important to watch out for. So I guess markets will be more bothered about how the RBI reacts to these developments. Fortunately, we haven't seen the oil price hike actually reflecting on the yields till now to that extent, but it's the rupee depreciation that it is reflecting into. So eventually the yields will have to move up, and the RBI will have to sort of take action on that. My sense is somewhere around August or October, you'll have to build in situations of a rate hike. And that, I guess, will keep the market on the tense ropes. And of course, then you have other plays around wherein we are seeing a mix of earnings. While the earnings have been generally positive, but the financial services sector has not really posted very great earnings. It's quite a mixed bag. So I guess that is a bigger issue to watch out for the markets.
Okay. I also actually wanted your point of view about global markets. We do have some movements with respect to the commentary my point was about the slowing down of FII flows coming through over the past couple of months. What bearing do you think that the global events can have when it comes to some of these fund flows coming in our markets?
Well, you're already seeing a reflection of that. If I recall the numbers right, FIs have almost sold close to about 4,800 crores of equities already in the month of May. Now, it's a classic readjustment that they're doing. India tends to be at a premium, and it continues to be at a premium. While the premiums have come off for India equities, they're still at a at a higher valuation versus some of the other emerging markets. So I would sense, given the deterioration in the macros, they will continue to be either average weight on India or a little underweight on India, because stocks are expensive. Markets at an aggregate level are quite expensive when you account for the fact that financial services will have a poor FY18 and possibly a poor FY19, at least the first half of it. So to that extent, I would expect the same stance to continue. And if rupee actually starts depreciating faster than what has been the case, I would expect a bigger sell-off from the FI side. Not to say that we're negative on the markets, but all we are saying is that we're more in the neutral zone, and we'll have to wait and watch as to how the events unfold.
Okay, Amit, hold that thought. We're going to take stock of what's really going to buzz in today's day of trade on the back of the whole lot of news that we've seen over the weekend. Of course, a whole host of earnings as well, and the possible reactions that we can expect in today's day of trade. We do have our research team joining us as usual. Good morning, guys. I'm going to start off with stocks and news as usual. Chadha, what do we have on list?
So, Agam, one stock that we definitely need to watch out for is AU Small Finance Bank. They're looking to raise about 1,000 crores from a unit of Thermax Holdings, and now they will issue equity shares and warrants at a price of 692.77 per share, and warrants are convertible within a period of about 18 months. So watch out for that name. Capital infusion coming in from a big PE name. That apart, you have Indiabulls Real Estate, where the buyback price has been fixed at 240 per share. You have Endurance Technologies, which has said that they're entitled for a 283 crore industrial promotion subsidy. Then you have Indoco Remedies, which has received 3 observations under Form 483 from the US FDA, and this is for their API plant at Patalganga. So you could see some negative reaction on that counter. In bulk deals, we had Welspun Enterprises, where promoter Balkrishnan Goenka Welspun Group Master Trust bought 1% stake on Friday. So again, possible reaction likely there as well.
All right, those are some of the stocks and news. But in terms of results, Nikki, starting off with the good ones, a couple of consumption names on your list.
So to start off, I'm going to start off with Bajaj Holdings, and investment in that case. Revenue is up almost 23%, and we're seeing a net profit of 42% for this counter. Second in the list, we have Prabha Dairy, which is again reported good set of numbers, mainly good show coming in on operational front. Revenue C2P have a muted growth of around 7%, but then the cost saving techniques in terms of the raw material expenses and other expenses have led to a good show on bottom line, which in turn has percolated down on the bottom on the operational front of the company. Net profit, the company has reported a figure of 18 crore as compared to a loss. EBITDA, we have seen a 37% uptick here. Also do bear in mind the fact that apart from operational good show that we've seen, also the tax credit of the company stands at around 6 crore as compared to a figure of around 2.85 crore outgo that we've seen in the corresponding quarter. And third in the list, we have Sheela Foam, where our revenues is up as much as 15%, net profit is up by 88%. This is on account of the higher operational efficiency. EBITDA is up more than 100% for this counter, which in turn brings the margin to 10% as compared to 5.2% earlier.
And Jay, some bad results too?
That's right, Agam. I have a couple of weak results and one marginal miss. Let me start off with that, which was Manappuram Finance, where the net interest income was up about 2% at 622 crores, while the net profit declined nearly 10% at about 182 crores on a year-on-year basis. Now, Thermax was weak, where the revenues declined 3% at nearly 1,450 crores. Now, this is despite the fact that net profit surged 70% at about 76 crores, but one has to remember that the base quarter had a one-time loss of about 65 crores. So, adjusted, we had poor performance for Thermax as well. Operationally also, EBITDA was down to 20% at 140 crores odd, and the margins contracted 200 basis points at about 9.6%. Finally, we have Future Lifestyle, which was also weak, where the revenue was flat at about 977 crores, and the net profit declined 64%. Now, there was an exceptional gain of 13 crores and a tax credit of 11 crores in the base quarter. So watch out for that one as well. Operationally, it was weak, wherein the EBITDA declined 5% at 88 crores, and the EBITDA margins also contracted 40 basis points at nearly 9% as compared to 9.4% in the previous quarter.
Right. And Yatin, we have a few good brokerage calls coming in through.
Yeah, we'll talk about Strides Sassoon, and most of the brokerages have cut the target price anywhere between 40 to 50%. So big target price cuts coming in for Strides Sassoon after that disappointing fourth quarter. Not only that, the management commentary on the conference call was also slightly disappointing according to analysts. Now we have Jefferies, which has maintained a buy on Strides with a target price of 600. They've cut that target from a level of 1040. They believe that the fourth quarter has been weighed down by the weak US and the institutional business. However, they say that the stock is not factoring in any recovery or risk, moving forward for the Australian business, which is quite attractive. And they expect a 35% EBITDA CAGR for the next 2 financial years, which is FY19 and FY20. Jefferies, of course, target price cut, but optimistic on the outlook moving forward. Macquarie also has downgraded the stock to a neutral. The target price has been cut to a level of 398. So big target price cut coming in from Macquarie. They say that the fourth quarter earnings performance was a huge dampener. The US portfolio shrunk significantly versus the management guidance, and of course Australia is one silver lining, which is on track. It can grow in early double digits. They have cut the FY19 and 20 earnings estimate by 52 to 50%. So big earnings cut coming in from Macquarie for Strides. So expect the stock to remain under pressure. On Friday, the stock was down 25%.
Yeah, that's right. We should be keeping an eye on Strides as well. Thanks, guys, for joining us and giving us those details. But Amit, I'm going to take the point of the cement sector forward. We've had UltraTech Cement and the developers there by buying some of the units of, Century Textiles. What do you make of UltraTech now with its positioning, and how does it stack up against the other bigger players in the industry?
Any thoughts on UltraTech?
Well, per se, the deal looks pretty good if you look at it on an EV basis. But of course, one will have to account for the investments that they will have to make for the upgradation of the plants, which is quite significant. These are fairly old assets, so it will require significant amount of investments. And also the operating metrics will have to be improved quite significantly, because if you compare the EBITDA margin which UltraTech makes on its cement sales versus that, it's almost at a 60% discount. So closer to about 400 rupees per ton is what Century made. So I guess they'll have to be making significant effort on upping that as an average. From the other side, I guess one will have to look at what is the residual value left for the Century shareholders. So we'll have to look at the finer details. But in general, I mean, very, very good and a long pending, expected deal for UltraTech in that sense, and helps them to consolidate their leadership position in the key areas. So to that extent, definitely a positive.
Okay. So many other stocks to talk about, with Amit. I don't know if individual comments on Strides Sassoon or some of the others, but it's 8:45 or 8:47 actually. So that time of the show when we should go and talk to our technical experts as well. Keep in mind, I think stocks like Strides Sassoon, stocks like Bajaj Finance, which has been on a roll for the last 2 days, will also be there. And then, of course, talk on what the individual names could do as well. Gaurav Bissa, he's Assistant Vice President at LKP Securities, joins us right now on the show with his stocks on the technicals. And Ruchit Jain, Technical Analyst at Angel Broking, for his chart check as well. Gentlemen, both of you, good morning. Many thanks for joining in. Gaurav, how are you looking at the positioning on the futures and options side, and what does it mean for trades today on the Nifty or on the Nifty Bank?
Good morning. We have seen incremental short positions getting built in both Nifty as well as Bank Nifty, and we've seen good amount of corrections already happening. Nifty as well as Bank Nifty are now trading around the support levels. There can be a 0.5% cut. It cannot be ruled out. But a significant fall from the current prices, I think that is going to be a little bit difficult since they are trading near the support levels. Whether the bounce back that we are going to see in a day or two, whether they are going to hold on to, or whether we'll see a sell-on rise, that's a different question altogether. But for now, I think one should have a positive bias. One should play for a technical bounce from the current prices. If you look at the option chain as well, 10,500 put option Nifty commands the highest OI concentration in the entire put series. So that again shows that there's a possibility that Nifty might fall towards 10,550. But then again, that would be a lucrative price point, lucrative price to enter into the Nifty futures for upside targets of 10,700. That would be a strong resistance in the near term. So I would play for a bounce back. I would not short at the current prices.
Ruchit Jain, good morning. Are you also expecting a technical bounce, or do you expect some consolidation to come through when it comes to the benchmark indices?
Yeah, hi, very good morning. Well, if we just see what happened last week, although we started last week on a positive note, but post Karnataka elections outcome, we had seen formation of the reversal pattern on Nifty as well as Bank Nifty daily charts. Post then, since last 3 trading sessions, the indexes as well as the stock specific momentum has been on the negative side. And if you find support levels now, next support from where market could see a bounce back, it's coming around 10,500, where technically there is a 89 EMA placed on the daily charts, as well as in terms of open interest on NSE front, 10,500 put option as highest OI. Now, if we see on the higher side, the resistances are now getting shifted lower. Earlier, where 11,000 call option had highest OI, now even 10,800 call option has attracted good amount of open interest in last 2-3 trading sessions. So we believe that in near term, at least this 10,500, 550 range should be tested once. So as of now, we are not recommending to create fresh long positions in the index. Any kind of pullback move, if happens, then 10,650, 10,700 would be the range where I think markets would again resist. So if one has to take a call on the index or one has to take a trade on the index, then there's no trade setup at current levels. But yes, any pullback move around 10,650, 700, I think those would be levels where one can create short positions with stop below about 10,800 for target around 10,500.
Okay, before we take our technical experts call of the day, let's move on to our special segment Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up. Jayesh, good morning. What's on your radar today?
Morning, Agam. I'm watching out for Jubilant Foodworks. That is because a few factors have played out in one single day. That is, the stock closed higher on Friday, and had heavy volume as well in a weak market on Friday. The other one is that, on Friday it closed above the 21-day exponential moving average, and the volume too closed above the 5-day moving average for the volume itself. And the analyst consensus price is 10% above the current price. So there could be good upside for the stock, and there is a buy signal on Jubilant Foodworks. Let's have a look at how the exponential moving average actually works and what are the conditions that you have to keep in mind. Well, it is a moving average which applies more weightage to recent data, and it reacts faster to the recent price moves, which is the 2% uptick that we saw on Friday. The other one is that it is better suited for determining the trending market. Now I'll show you on the chart where the trend actually has emerged on the exponential moving average. If we can go to the chart, so the green line on the top panel is the 21-day exponential moving average. The last bar, you can see that it has actually closed above this. Now where the trend actually comes in is that we had a steady downtrend from 2,700 plus levels to nearly 2,400. This was the downtrend that we have referred. It has actually most likely created a bottom over here by the price has actually closed above the 21-day exponential moving average. It has, so this trend has actually reversed and it has started going up. Now why I say that this has actually reversed is because of heavy volume. At the bottom panel you can see that the volume bar, the last one, this is significantly higher, and the 5-day average volume also. So there was buying on Friday's session on heavy volume.
And in the past, has this worked beautifully for Jubilant? I mean, any past instances, Jayesh?
Neeraj, it's worked like a charm. There have been 6 instances in the last 1 year where this indicator has been hit. All of them have resulted in a gain, and average gain on each trade would have been about 9%.
Wow, that's something. Let's wait and watch. So the Bloomberg terminal indicating, Jayesh, thanks for bringing that very interesting chart. The terminal indicating that Jubilant Foodworks could well be a stock that people could look at trading on the long side. Let's see. We'll talk to our experts about that as well. But first, let's talk to our experts about their calls. And the reason I go to Gaurav is because he does have Jubilant Foodworks as a buy call. So, Gaurav, Bissa, you're seeing Jubilant, as per your indications as well, giving a buy call, that and the call that you have on UBL.
Well, yes, I mean, there's not much to add. Jayesh has explained it beautifully and in depth. I would only add a couple of pointers that, yes, in weak market also we saw about 3.5% OI addition happening in Jubilant Foodworks. So it has been seeing consistent long positions. It has been gaining grounds. It has been quite strong. So yes, it can test levels of 2560, 2570. And if those levels are held, then yes, the average price targets of 9% that Jayesh mentioned, that can be seen in next 3 to 4 trading sessions. So one can have a stop loss of 2480 and buy Jubilant Foodworks for targets of 2560. Second would be buy on UBL. Again, similar kind of setup for the reason that in weak markets it has garnered around 8% over addition. So strong long pushes were seen getting built in weak markets. It has been trading between the range of 1100, 1135. 1135, 1140 is the immediate hurdle. Once that is crossed, I would not be surprised stock heading towards 1200 mark. For immediate gain of 1165, one can have a small stop loss of 1118 and be long in UBL.
Ruchit, you like Dabur, but you also have a sell on IDBI Bank. Can you take us through your calls, please?
So we have seen that during last week, in spite of market correction, FMCG was one of the space which has attracted very high volumes. And not only in terms of volumes, but also in terms of price performance, the outperformance was seen vis-a-vis the other sectoral indices. So I think this FMCG space will continue to attract momentum as of now, in spite of markets looking a bit negative. Dabur is one of the stock which, after an up move, has shown a consolidation phase since last 1 week. The volumes are good during this consolidation, which is indicating that probably the formation of the flag pattern which has been formed should be materialized, and we should see further high levels from where they are right now. So we are recommending to go long on Dabur with stock below 364, which is lower end of this last few days consolidation, for target around 386. And IDBI Bank is one of the stock which has continuously shown an underperformance, although since last 2-3 months the volatility is quite there in the stock. But no, the stock is still looking weak, and we sense that the next support levels for the stocks are coming around its previous lows of 56.5. So I think the stock should test those levels. One can go short in futures segment in May futures with stop loss above 63.5 for target around 56.5.
Right. Well, Amit, I actually want to address the pharmaceutical sector with you. What we've seen is a lot of volatility over the previous couple of weeks. We had very disappointing earnings from Strategist. We've seen some weakness in Sun Pharma. Cipla has also been bearing down. How do you play the sector, and is this a little more individual based on the US FDA activities on a lot of these stocks right now?
Well, I guess so. One part is the US FDA approval cycle, which eventually has to start panning out over the next couple of quarters. I must say that we thought by this time we should have got some positive news on the front.
Right.
Unfortunately, that's not been the case. But in general, we find most of the correctives have been in the price. It's only a matter of time now that the news starts turning for the better. But the other concern which we have is that the pricing pressure in some of the markets is still continue to be there. I mean, while the pace of decline has slowed down quite a bit, but the fact that the pricing is still under pressure sort of leaves some room for concern. Now, whether it will sort of unwind over the next 1 quarter, 2 quarters, that's difficult to say. But in general, we find there's significant value on some of the names, especially the large cap pharma names. Significant value there. There's significant assets built into those businesses, and therefore, if one has a 3 to 5 year view, definitely some of these names are worth a portfolio allocation.
Interesting. Let's talk about some individual names as well, and pockets that you may have some coverage. We're talking about how oil and oil-related stocks have been in focus. Fuel prices are on the rise. So the usual stuff that people talk about are OMCs. Sure. Beyond that, there are a bunch of oil companies, lubricant companies, so on and so forth, which have also been in focus. Castrol, the numbers all over the place. Gulf Oil Lubricants, the numbers seem fairly okay. Do you track this space by and large? Do you track anything within this space?
We do. We have been fairly bullish on Gulf Oil Lubricants, and that is evidenced by the performance that it showed up. Very good numbers. A little lower than our estimates, but we'll have to figure out what's the final details on that. But overall, the numbers look exceedingly good. The other space which we are actually recommending to investors as a hedge against rising oil price is city gas, because that has lesser government intervention on pricing. It is a green field, so therefore there's a natural push by the government agencies towards that, and the companies have actually taken pricing which essentially covers them up for the next quarter or so. So there we believe that IGL and MGL would deserve a fair amount of allocation versus the traditional OMCs.
Okay, the question is that MGL as a stock has fallen and fallen quite considerably post the block deal. Has fallen even more after that, right? 860 or thereabouts was the deal happening at 911. Are valuations strongly in your favor, and therefore would MGL be a better bet than IGL?
Well, that's a difficult call to make, because we've traditionally been more favorable towards IGL, considering that it has a better ROE mix, it has a better business mix in terms of how they sell their fuel, and their ability to expand their area, the geographical area, is far more than MGL. And therefore, from a structural perspective, I would be more bullish on IGL. Remember, there's a pending auction of the new circles, which is going to be done by PNGRB.
Yes.
And IGL has a very strong advantage because they can keep expanding around the NCR area and keep adding new assets, new geographical areas at an incrementally lower cost. And that to us is a very, very big structural advantage that IGL has. And therefore, I would be more sort of attuned to go overweight on IGL, but also have a weightage on MGL, which is a play on the Mumbai market.
These could well turn out to be multi-year stories, right? You keep on adding geography after geography, and they're very nascent stage of geographical addition as well. They probably cover what 1/20th of the country right now.
Absolutely.
Right. Well, as Sumit has also been pointing out, especially when it comes to city gas distribution companies, he has also suggested that there's tremendous scope. But where we're going to have to watch out for some of these. But we just have about 30 seconds left before market opening. So let's take a look at where the Asian markets are currently trading at and see whether or not they're going to have any inclination whatsoever when it comes to our own markets. For now, it's stand where they are. Strength coming in with about a 0.5% up move when it comes to Nikkei, Shanghai and Hang Seng a little stronger. In fact, Hang Seng up as much as 1.2%. Have you seen any change in SGX Nifty? No, not really. Still at around 10,620. Not too much to speak for. What bearing can this have on our own markets when it comes to pre-opening? We should start getting rates when it comes to the Nifty and the Sensex. There you have it. It's on your screen. We're looking at a negative tick when it comes to the Nifty, a rather sharp one, I would say, because a negative tick of nearly 1% there. Sensex, on the other hand, is well marginally in the green for now. Well, we will keep an eye on UltraTech Cement specifically. Well, we're likely to see an up move there, and there you have it. That 9% up move on UltraTech Cement and a 10% down move on Century Textiles. Of course, this is going to be crucial, but this is just the initial rates. We'll have to wait for some of these rates to settle down. That said, we've had a stellar run for Bajaj Finance last week. Can we expect some consolidation, or are we expecting an up move? Bajaj Finance showing a downtick of as much as 10%. Like I said, we'll have to wait for these rates to stabilize before we start, come to any conclusions for now. And Cipla and Sun Pharma, which had a very weak last few trading sessions. So Sun Pharma were down by as much as 0.2%. Cipla is again showing us marginal movements. And finally, just two to three stocks I want to address because we have CLSA adding some of these stocks in their value picks. So I want to address HDFC Limited. Of course, it's been a steady counter, and there you have it. That's looking at a near 4% uptick there. And the other one, of course, is M&M. M&M is the other among many, which is also looking at, well, in that, CLSA putting in as a value pick, but marginal moves for that. Watch out for some of these counters. So on the whole, looking stable, and the Sensex and the Nifty both indicating marginal open for now.
Some stocks in news. UltraTech Cement looking at a strong uptick. Don't think it'll have a 10% uptick, but let's wait and watch. Contrary, let's look at Century Textiles as well. Yatin mentioned that the dealers expected that the stock would start off on a negative note. 10% slam dunk. The cement business of Century has been valued way lower than what the expectations were, and therefore a slam dunk on Century Textiles. Not saying it'll start off 10% lower, but suffice to say there could be some bit of pressure on Century Textiles. Bring up Prabhat Dairy, result reaction if any. Let's see if there is something there in the pre-open session. Also bring up Thermax and see if the stock is reacting negatively to what was arguably not the best of numbers for now. No, not too much of a reaction. Ashok Leyland came during the dying. Sheela Foam, yeah, 3% higher. Good set of numbers out there. That stock is up about 4%. Ashok Leyland came in during dying moments of trade. Let's see if there's a further reaction. No, not quite. Last but not the least, Stride Sashan. Big cut in Friday's session. Let's see if it is reacting duly. For now, holding on. I think Yatin comes in and speaks about Stride Sassoon, but okay, let's first go to Yatin, then we'll mark the currency and the yield bond market.
Strategy.
E. Johnson right now with the big brokerage calls for the morning. Yatin.
Well, Neeraj, apart from Stride Sassoon that we discussed in the huddle, we have a CLSA strategy report coming in. They believe that the consumer sector is something which one should look at in the periods of uncertainty. They believe that the consumption theme is a no-brainer during macro uncertainty, and in terms of return, there could be some good potential in few stocks that they name later. We have the government, according to CLSA, which is trying to increase its popularity by spending on welfare programs. And probably because of this, we have seen a good pickup in the rural consumption, and probably that remains a theme according to CLSA. They believe that the value picks in the consumer segment or the consumption segment remain M&M, ITC, as well as Glaxo Consumer among the large cap. In terms of the mid caps, we have Dr. Lal, DB Corp, and ICICI Pru, which CLSA believes could deliver good returns. And apart from these stocks, we also have Z and HDFC in the list. So a whole host of financials, consumer stocks, FMCG stocks, and M&M, of course, in the automotive space due to the exposure in the rural markets.
Well, thanks, Yatin, for bringing us those details. That's a comprehensive list of the stocks that CLSA is betting on in the Indian equity markets. But moving across to put a little focus on the primary markets, there is a new kid on the block. Mumbai-based IndoStar Capital Finance is headed to the bourses today. And remember, the NBFC, backed by Everstone, has, raised as much as 1,840 crores through its public offer earlier this month. Chadha Babla is standing by to tell us about the company as well as the response its IPO has got. Chadha, over to you.
Well, yeah, so the IPO issue, the issue price has been fixed at 572 per share. And do remember that despite a mixed verdict coming in from brokerages with respect to subscribing to the issue, we did see a reasonable amount of demand for the issue, total 6.8 times, and that was largely led by QIB and HNIs, by retail portion just managed to sort of scrape through. More importantly, just a quick recap of what this offer was all about. The total, the company was looking to raise 1,844 crores, out of which fresh issue was just 700 crores, which will go to the company, and that will be used to expand its lending operations. On the other hand, 1,144 crores was an offer for sale, a large part of it coming in from the promoter, which is called IndoStar Capital, and some other shareholders. So the promoter shareholding would now fall from 91% to about 59%. Now, if you look at the company, it's just started recently. It started operations in 2011 and is backed by the Everstone Group. With respect to its business portfolio, it's largely a corporate lender. They started with corporate lending operations in 2011. So a huge chunk of their loan portfolio is corporate lending. And out of that 77%, a large part, again, more than half of it is lending to real estate developers. They started SME lending in 2015, so that's another 22% of the portfolio. And they have recently forayed into home and vehicle finance, which is a small 0.5% right now because they just started in October 2017. This is the retail bit that they expand to grow going into the future, but largely a corporate holder for now.
What about the financials, Chadha, and how are the valuations stacking up vis-a-vis some of the peers?
All right, so if you look at the financial pictures over the FY13 to FY17 period, their credit exposure grew by 30%, CAGR, net interest income and net profit have also grown in excess of 20%, so good growth numbers coming in. As far as some of the financial parameters are concerned, the gross NPE number, which is the most important, if you look at that, if you move on, it has gone up from 0.8% in FY17 steadily every year to about 1.7% as of 31st December. Nevertheless, 1.7% seems like a reasonable number given that it has a corporate focused lending book. That apart, return ratios, they seem a little, or less slightly muted if you move on. Yes, ROE is at about 10.9% and ROA is at 3.8%. If we do a certain scenario analysis, this is the picture that we get. So we had spoken to market participants and they said that it's more likely that the issue will list at a premium of about 20 to 30 rupees. So at the issue price, if it does list at 572, the price to book value ratio was at about 1.8 times, which moves to about nearly 2 times if it were to list at a 30 rupees premium at 602 rupees. At 1.9 times, brokerages had opined that the valuations do seem reasonable given that it's a relatively small size player. And if you compare it to Capital First, Shriram City Union and Mass Financial, the numbers for IndoStar Capital, the valuation looks cheaper. But remember, these are SME players which are mostly focused on retail lending and hence a premium valuation is justified. Piramal is another one which is a sizable real estate lender, but again, they're not directly comparable peers given that they have a very varied AUM book. Nevertheless, 1.9 times is not expensive. That's the word coming in from analysts, and sizable premium listing likely.
Thanks for that, Chadha. We'll watch out for this one. Amit, I don't know if you guys track IndoStar, but your answer in the earlier half of the show suggests that you're not too gung-ho about NBFCs.
Well, financial services, and whether that PSU banks in particular.
Okay,
in
not
fact,
NBFCs.
it will be a structural opportunity for some of the good quality NBFCs to gain market share.
Okay.
And that's a very, very significant play. In fact, if over the next 5 to 10 years you're going to take a structural view, because PSU banks will essentially be on the defensive. Capitalization is going to be challenged. Some of them will eventually get closed down over the next few years. So good quality NBFCs and the larger private sector banks will be significant gainers of this opportunity. But on the flip side, we do not know as yet as to what impact it will make on the cost of funds, especially for the SMEs. Because PSUs were quite competitive on that front. Now with the PSUs out of the picture, will the NBFCs start charging a little bit of a premium for lending to those SMEs?
Do you track this one?
No, not specifically this one.
All right. Well, I was going to ask the same question, but in any case, then in that case, let's move on and address what's happening in consumption, Amit, because we've had Jubilant Woodworks numbers come in, and we've had some very strong trends now building up in the consumption space in general. What's your view here? How would you play this entire theme now? Would it be staples? Would it be retail? Would it be discretionary then? How would you go about this particular area?
Well, I guess it'll be mixed to play the India consumption basket. So staples we definitely liked. We were getting enough signals to suggest that the volume growth for the Q4 will be strong, and as we go along, it will only get better. So we're not surprised by the way the earnings are panning out. I mean, double-digit volume growth for some of the large FMCG players is quite stupendous. Having said that, the valuations do capture to a fair degree all those trends. But in general, we've liked Hindustan Unilever in specifics, and balance that on the portfolio with ITC, because ITC as a stock is at significant discount to the leaders and to the averages. So I would sense that the absence of a price hike on the GST rates, the extra duty that has to be built in, is not likely to happen at least before August or September. And if that were to be the case, I guess ITC probably has a little bit of a tactical play on that front. The other side which we like on the discretionary side is more on the theme of unorganized to organized. And there we like footwear as a space, and our favorite there has been Relaxo. Had some very good earnings reported of late. And we believe that over the next few years, India will move towards brand consumption. And footwear is one of the biggest segments which has been unorganized and not a brand play. And there will be some models which will emerge, and we believe Relaxo will be one of those models, having significant presence in the value, moving towards the premium, and then the super premium. So that's how I would probably play that model.
Okay. Stay on with just a moment. Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. All eyes on UltraTech Cement and Century Textiles, as the former is set to take over Century's cement assets in a share swap deal.
AU Small Finance Bank will be raising 1,000 crore rupees from Thermax unit via share sale and warrant issue.
Street will also watch out for Indiabulls Real Estate as it looks to buy back 2.6 crore equity shares or 5.45% stake at 240 rupees per share via the open market operations.
And what comes as a setback for Indico Remedies are 3 observations under Form 483 for its API plant in Patal Ganga.
In bulk deals, Welspun Enterprises promoter entity buys 1% stake at 178.5 rupees per share.
And brokerages turn bearish on Strategist after a disappointing March quarter and a weak management commentary.
Okay, so those are the stocks to monitor. Just a quick thought from our experts, technical experts on some stocks and how they are starting off as well. Gaurav, Bissa, the last few days have been terrific for Bajaj Finance. It's likely to start off marginally lower. If you were long in this stock, would you keep a stop loss after it starts off about 1% lower, or would you take money off the table?
No, the trend seems to be strong for the time being, and I would not like to exit the stock. One can have a stop loss of a couple of percentage points. The 2080, 2090 would be the trailing stop loss. If these levels are held, it can retest the previous high levels. I think with the kind of volume participation that's seen, I would play with the trailing stop loss.
All right, Ruchit, I know that we're still waiting for the opening for UltraTech Cement, but any key levels in mind for now, or would you want to wait for the opening to come through?
I think post-opening also, the first half an hour would be quite crucial in this stock because although we may see a gap-up opening, but the kind of negative momentum has been seen in last 4-5 trading sessions. It needs to be seen where the follow-up move would be there. In case if the stock opens positive and on the higher side 4,010, it can resist, since there's a resistance around 4,010 and 3970. So I think if there is no follow-up momentum, then we would not see any significant move in spite of a positive opening. So I think first 15-20 minutes at least should be seen post-opening in this stock.
All right, just a minute and a half before I take the top picks from some of our technical analysts. Gaurav, your quick view on HUL, which has been on a tear. Can you tell us about the levels that we can keep an eye on?
It has seen good amount of long positions. There has been aggressive volume participation also that we have seen. The levels to watch out for on the lower end supports would be on 1565. Since it's at the multi-month high levels, on the upside targets of 1640, 1630, 1640 would be a very crucial level. If these levels are not crossed, we may see some amount of unwinding happening. But on the lower end, 1565 is what I would be looking at. It's buy on dips stock for the time being.
Okay, Gaurav, just about 50 seconds left. Your top pick for the day.
It would be Jubilant Foodworks. I think major part has been explained by Jayesh, but the kind of consistent long position that we have seen getting built, my top pick for the day would be Jubilant Foodworks.
Ruchit, 30 seconds left. Your top pick for the day?
For the day perspective, Mindtree would be a good buy at current levels. The pre-opening prices are suggesting a minor gap up opening. During this recent correction, volumes are very less. So I think the stock should resume uptrend very soon now. So go long on Mindtree with stop below 995 from intraday perspective.
Okay, stay on, gentlemen. We'll just take in opening thoughts from each of you after the market opens, but 12 seconds left for the markets to start. Expect a start which is marginally in the green, but arguably flattish. Banks could hold the key. The Nifty Bank looks like it'll start off on a positive note, but here are the first rates. And boy, the Nifty Bank about 0.6%. We seem to be ignoring what's happened on Saturday completely. Maybe the global market mood is helping the start. Let's see if it lasts or no. But about 0.25% for the Sensex as well. Slightly off now, but the Nifty Bank holding fort, which is actually a good sign. Mid caps and small caps. Remember Friday, after two strong days, Friday was a bit of a pullback. In today's session, a flat start. So there's no clear trend, at least at the broader end of the spectrum. The heat map should show UltraTech right up there. Yes, more green than red. That's one good sign. Two, we don't have too many big losers in the session today, which is the other good sign. This is quite contrary to what happened in Friday's session. And look at the gainers. Banks seem to be doing reasonably okay. At least SBI and ICICI Bank are. And UltraTech Cement has a couple of percentage gains. So that is arguably the newsmaker, which is doing very well for itself. Aside of that, no clear trends here. So let's talk about some of the newsmakers and try and see what they are reacting, how they are reacting. We already know what UltraTech is doing, but important to bring up what Century is doing as well. So, well, a slam dunk for Century Textiles. That one is down about 7.5%, but UltraTech Cement starting off 2.5% higher. So it's defying what's happening to ACC and Ambuja in a big way by doing a lot of things of its own. What else? Let's see some of the result boys, some stocks which saw some price cuts. Brokerages have slashed. Cut is actually an understatement. They've slashed the target prices on Stride Sarshan. That stock is down another 3.5% in the session today. Not a good start for this one. Let's see some result reactions. Prabhat Dairy starting off on a good note. Sheela Foam too, about a couple of percentage points higher. What's not doing well is Bajaj Holdings. It was expected to come out with a good quarter by virtue of what all of its holding companies had done. And therefore, maybe the market expected it just about flat in the session. Agam, what about you?
Well, broader market is looking good too. We have some momentum coming through. We have Bame Lorry, which is now up 5.2%. Bame Lorry is now the top gainer on the Nifty 2, up 5.2. And that's followed by something like a Bhushan Steel. Of course, we've had conclusion of their deal with Tata Steel, and we've seen an uptick of 5% yet again. We're seeing some strength in Bank of India. This is after so much weakness in the entire public sector banking space. We're seeing an uptick of around 4%, and Vinity Organics now comfortably above the mark of 1,000 after strong commentary coming in from the management suggesting a 35% growth in profitability. Sadbhav Infra is also catching up with a lot of its peers. That's also up around 3.5%, and Sadbhav Infra is also one of the preferred plays by a lot of analysts on the street when it comes to the road transport segment. And AU Small Finance, of course, are up as much as 2.5%. They are looking to, well, raise as much as 1,000 crores, and that is likely to provide some impetus going in. On the weaker end, Kitex Garments, that's down by a 17.5% now, and this is the biggest loser on the Nifty 500, and that's followed by Century Textiles, as we've already spoken about, but ITI is the other one that's down 5.7%. Reliance Communications and Reliance Naval, both these stocks had a tremendous run over last Thursday and Friday, and now it seems you're looking at some amount of profit taking. These cuts are not as deep as the kind of up move that we've seen over the last 1 week. This is perhaps some correction and some profits taking in there, and Delta Corp is the final one that I want to address right now. That's also down around 4%. it's been fairly volatile, but largely well strong over the past couple of weeks. And once again, it seems that traders want to take some profits in this one as well. So, but on the whole, however, Neeraj, the broader market's also looking reasonably okay, but the benchmarks are now starting to decline once again.
Yeah, down about 0.25%. By the way, Kitex, I don't know what the news is, but down about 17.5%. Amara Raja has reacted very strongly to its numbers as well, 6.5% down, the second highest loser on the BSE 500 or the NSE 500. Opening thoughts before we take in final thoughts from Amit Khurana. Just a quick opening thoughts because the Nifty's come off quite rapidly from the levels that it started off at. Ruchit, Jain, any thoughts here on open? Would you take any trades on the Nifty or any stock that catches your eye?
I think on the Nifty front, we still believe that 10,500 would be the levels which should be tested very soon. But whether that would test after a pullback move or from current level itself, that's a very difficult to take a call. So I think I would avoid creating any long position on Nifty as of now. But yes, in intraday, if we see any kind of pullback move up to 10,650 again, then those would be ideal levels to create fresh short positions for target of 10,500.
Gaurav, what about you? Any thoughts on open with the way the markets have started off? Even the Nifty Bank has cooled off. And of course, if there is any stock that pops up on your screen as a trade.
As far as indices are concerned, I think I would be buyer in Nifty. As I mentioned at the beginning of the show, 10,550 is what I would be looking at. I would buy around those levels, have a stop loss of 10,500 on the upside. 10,650, 10,700 is what I would be looking at. For stocks, I would still give it a time. There are stocks that are quite volatile, so to speak of, but among the safer ones would be ONGC. This is one stock that has been withering the storm. A couple of days back, we saw some amount of openness also building up. So at the current price of 187, 188, I think this is one name that can be bought into. A stop loss of 185 on the upside, 192 can be seen.
All right, well, we'll let you guys go on that, Gaurav as well as Ruchit. Thanks for joining us and giving us well, your views on the markets. But with that, Amit, I'd like to shift focus to the media sector. You know, we've seen a very sharp up move and outperformance from broadcasters like Sun TV and TV Today. And we've also started looking at traction in Z Entertainment once again. How do you view this sector right now?
Well, there are pockets within the media space, so whether you're looking at electronic media, whether you're looking at print, you're looking at the radio segment, and then the exhibitors, of course. So our stance on electronic media has been negative. We sense that the valuations currently capture all the optimism that is likely to play out over the next 4 quarters. On the other side, we've been slightly pushing the radio as a segment to play out versus the electronic media, and the primary reason is that radio as a segment has sort of underperformed over the last 6-7 quarters because of certain specific reasons. The demonetization that hit them, then the GST transition hit the advertising revenues. As you get into the election season from here onwards, the volume growth story will start. The utilizations will be better for radio, and therefore their ability to raise prices, which is a huge operating leverage. So we are more attuned to playing out the radio segment within the media space, and negative on the electronic media, and neutral on the exhibitors.
Battery makers, Amit?
Very positive.
Very positive. The Amara started off very poorly, which is
but I guess the earnings have something to go there. But I guess over the next 4 quarters, the way we see the visibility building up, I guess battery makers should do relatively better off.
Okay. So you are indifferent between the two, or do you have a preference for one over the other?
Well, it's more like playing tactically here and there, but in general we prefer Amara Raja.
Amit, we've seen crude strengthen right now, as you already mentioned. The worst sector to be, of course, to have exposure to here is the OMCs. But other than that, how would you play this theme right now?
The energy space in general?
Yes.
Well, as I said, we prefer the city gas companies, and we also prefer the input story there, which is lubricants. So
and what about the companies which have high exposure to crude in terms of input costs, such as paint companies, for example?
Well, I guess there will be a time lag effect to that showing up in the operating expenses. We're seeing evidence of that already, but whether it makes a material difference to the way we are forecasting our earnings, not yet. But if we were to go towards a $90, $100 and persist there, the important part is how long does it stay there, and is it gradual or volatile? I guess if it's gradual, the ability of the companies to pass it on will get put out. But if it is a very sharp hike and that leads to a significant depreciation of the rupee, which is not our base case, I guess we are looking at a more gradual rise over the next 3 to 4 quarters. Then I guess things are all right. But the balancing part of that, and that's a very important equation to look out. How does the food inflation work? Because till now you've seen only crude price inflation coming into the picture.
Right.
If food price inflation also starts playing out, then I guess it's a very, very negative development to look out for. Fortunately, that's not been the case till now.
Okay. Amit, we'll let you go on that note. Thank you so much for taking the time out and being with us today, giving us your views as well. Politics, markets, and lots more. That's Amit Khurana of Dolat Capital. A bunch of ideas for anybody who tuned in right now. For some very interesting names to watch out for as well, and some very interesting themes, more importantly, to watch out for. What's not doing well today? Let's start off with those. Maruti Suzuki, as things stabilize, is down about 1.5%. Sun Pharma continues to grind lower, about 1.25%. On the flip side, well, UltraTech Cement is that big winner. State Bank of India about a couple of percentage points higher. It's turning out to be a very normal day. It's not turning out to be a day which has big news flows. One on the local front, which is the Karnataka politics. Two on the global front, where US and China have called off the trade war. So-called trade war, I might add. But it's turning out to be a very, very normal day. No big news, no big movements otherwise. Must say, sugar as a pocket seems to be doing reasonably okay for itself right now. Balrampur Chini, Bajaj Hindustan, a clutch of other names have just started off on a slight positive note. Let's see if this lasts for them. On that note, let's get in one more voice on the show and try and figure out how would Rahul Chadha, he's co-chief investment officer at Mirae Asset Global Investment, and he joins us on the show. And let's ask him, how does he view all the developments and the impact on from a foreign investor's perspective in the Indian market? Rahul, good having you. Many thanks for joining us at Bloomberg Quint. What would your thought process be as we come to the fag end of Q4 earnings reportage with all that's happening in the political front and commodity prices, especially oil, doing what they are doing? What does all of this mean for somebody who's investing from outside into India?
Okay. So if you look at India, the micro situation is getting better as envisaged. Again, these were the signs one was getting over the last 3-4 months. You're seeing volume pick up across consumer staple companies. If you look at the banks or the financial services, retail or business banking is doing well. So that's the positive part of the story. I think what's weighed on minds of most investors is currency and the depreciation we've seen of 5 to 7% YTD, and is it more to come because of rising crude oil prices, the slightly worrisome situation on the trade deficit front, and globally the strength of the dollar. So I think it's really the macro issues kind of negating or neutralizing the improvement on the micro.
Rahul, good morning. How are foreign investors viewing developments when it comes to well, the political environment in India right now? Does it have any bearing whatsoever, or is there some concerns with the way things have been going about?
I think leave aside state elections, what it brings to the forefront is the risk which comes in 2019. Should we see a not so clear majority for the ruling party in the general elections? And this, coupled with the fact that most foreign investors are overweight India, means the appetite to increase India from here would be limited, basically.
Interesting. Rahul, almost everybody that I speak to off late mentions the relative unattractiveness of India compared to some of the other peers, despite the earnings growth. As you mentioned, the micro is turning around because of two key factors. One, which is unpredictable, and that is what crude is doing. High right now, may come off later on. The other part is what's happening to the two domestic macros, which is one, the currency, and two, the bond yields. How big a point could the bond yields be from an investor's perspective? Because like it or not, inflation is shooting up, with oil doing what it is doing, likely to shoot up even further, and that may result in yields moving up going ahead.
Yeah, so I think that's where investors want comfort on the macro. You want the tax collections to pick up because of improving economy, because of, again, this implementation of GST. Should that not happen, it's going to be worrisome from an investor perspective that, look, valuations are not cheap compared to other markets like Korea and China. India's got good micro, but very often we've seen in the past that it's the macro which has derailed the good micro story in India time and again. So I think that's where people are not really bearish, but look, they're kind of a reluctant bulls at this point of time on India.
All right, Rahul, then let's talk about consumption then. What's the best way to go about consumption in India right now, and what are the areas that you'd, well, should I say, place new money in?
Okay, so again, I think financial services is still an attractive way to play the consumption, and this is a sector which captures the opportunity in retail credit, captures the opportunity in SME credit, etc. So that's where we think banks with good liability franchise, which should help them weather the rising cost of credit, should be a good way. Selectively, I think autos look interested. Valuations are reasonable compared to the consumer durable space over there, so that's something we like. We've been long-term holders of some of the retailing names. Valuations are not cheap over there, but for somebody who's got a 2-3 year perspective, that's attractive. We're still taking a call that, look, with domestic economy improving, housing having bottom and improving, cement can be a good way to play the improve infrastructure spends and the housing recovery. So those are the spaces one would look to add or put fresh money here.
Rahul, would you buy into the story that the managements of top technology firms are now suggesting that they're likely to start seeing double-digit growth eventually, if not in FY19, then FY20? And would that change your stance when it comes to technology in India?
I think that's still a mature sector. You may see growth uplift for a couple of quarters, but we still have our reservations whether that can be sustained beyond 1 or 2 years. And already we've seen some of the growth uplift reflected in the valuations for these names. Should the core view be that the currency continues to depreciate by 5-7% over the next 12 months, I think technology may outperform. But beyond 12 to 15 months, there is limited visibility because the size is fairly high for these guys, though the digital part of the revenues is ramping up well, but the legacy revenue continues to be under pressure.
Interesting. Rahul, are you keen to play the capacity utilization uptick theme in India? And if so, are you looking at companies which cater only to the domestics, or are you largely looking at companies which are catering to the international markets as well? What manufacturing works for you?
Okay. No, this is a theme we like of EMC. Typically, EMs do well when global growth picks up, and which is a situation like this. Last couple of months been tough for EMs because of dollar strength, but our view is with the combined deficit for US, which is fiscal trade deficit, kind of bordering around 6 to 7%. I think dollar is kind of a peak for the time being, and it's going to be at least a year and a half from now where we see resume dollar strength. So clearly EM should do well with this backdrop that global growth is strong and capacity utilization picks up. And that's where one is looking at selectively some of the corporate expenditure plays or some of the names like the way you suggested where capacity utilization picks up. So cement is one of them. You've got industrial manufacturer like Thermax, which may be interesting from that opportunity. So you're looking at those plays. See, we've not seen much happen in terms of capex over the last 4-5 years. But with steel companies seeing good utilizations, and we'll see demand in excess of supplies in the next couple of years. First, we'll see metal capex pick up. Should oil remain in north of $70-75, you'll see energy capex pick up. So clearly, from a historical perspective, we are bottom of the capex cycle. Hopefully, things should look up if the global growth momentum sustain.
Yeah, and in fact, we'll have the management of Thermax just after your interaction, Rahul, right here on Bloomberg Quinn. One more question. I mean, the other part of the question would be, one is manufacturing capex picking up and therefore some of these themes improving. The other is the financiers of these capex. Now, until now, PSU banks not lending, the retail-focused financiers were the beneficiaries. Do you think the non-retail or the higher capital-focused financiers would now come into play as well? Do they stand a chance of catching up on the valuations and the AUM growth over the course of the next couple of years at least?
Yeah, no, absolutely, you're right. See, what's happened is the whole problem with some of these private sector corporate banks was that the provisioning on these bad loans or so-called these restructured loans was not adequate. These guys were sitting with 10-15% provisioning, whereas the haircuts which were required were close to the extent of 50%. And now we've seen most of them kind of do the necessary provisioning, or for the guys who have not done it would do that in next couple of quarters. So when you've done 50% level of provisioning, hopefully the assets get disposed and you don't make further losses. There are positive write-backs like the way we've seen in case of Tata Steel in recent times. So with that as a backdrop, credit growth picking up, your again price to books for some of these names around 1.5 times book, there is an opportunity over there.
Rahul, there has been a lot of debate between private sector banks and on the other side we have non-banking financials which have also been doing well. Where and what areas do you find more value as of now if you compare these two?
Okay, so if you look at the private sector corporate banks, clearly like the way I said, there is value over there. It's really a question is the large part of the provisioning behind us, and like the way I said, I think that should be done in next 1 or 2 quarters. So there is a valuation catch-up which is likely to happen over next 12-18 months for these names. On the other hand, think of these non-banking financing companies as somebody who in a constantly evolving business model. They were consumer companies. They still are, but the business was largely restricted to consumer until 6-9 months back. But then they sensed an opportunity post demonetization in business banking, SME credit, and that's come up and that's become a big growth driver for some of these companies. So those are good, smart companies. I think there the earnings growth would be in line, or there the stock returns would be in line with the earnings growth. Multiple re-rating is an unlikely kind of an opportunity from here. And that's where corporate banks may outperform these NBFCs who would be consistent return stocks over next 12 months here.
Chadha, we leave it at that. Thanks for joining us and well, giving us your view on the Indian equity markets. We keep track of that, and with that, we move on. It's time to take a short break, but on the other side of the break, we decode the March quarter earnings with MS Unnikrishnan of Thermax. And what should we expect from markets as the political environment begins to warm up to the run-up to the 2019 general elections? We ask Tirthankar Patnaik of Mizo Bank. Stay tuned in, lots more lined up. Keep watching Bloomberg Quint.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
What if lucky discoveries could be discovered without luck? What if the secret code to investing was no longer secret? Could the complexities of business not be so complex anymore? Decode, demystify, learn. BQ Learning. Only on Bloomberg Quint.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Strong order inflows marked the last year and the quarter. However, quarter 4 FY18 was a miss for Thermax. The capital goods giant also had to absorb a loss of 65 crores from his joint venture with Babcock and Wilcox to build supercritical boilers. What's heartening though is a 45% jump in order book. So can we expect these new orders to start reflecting on the bottom line soon enough? Let's get in someone who is the answer. MS Unnikrishnan, the CEO of Thermax, joins in. Mr. Unnikrishnan, good having you. Many thanks for joining in. Would you dismiss what's happened in Q4 as a one-off? Because if I just look at the previous few quarters, if I look at the order inflow coming in, things seem to be okay, but for the reportage in quarter 4.
Neeraj, it's true that for Q4 the performance had not come to our expectation. Primarily on the top line revenue recognition, we have a shortfall of near to maybe, I would say, we could have done a 10% more than what we already done, which would have meant that overall we would have had a better performance for the Q4 as well as for the year. But nothing to worry. This is only in some of the projects that we expected to be moving in at a faster pace. A confusion related to e-way bill happening. We have taken a considered decision that we will not move the goods unless there is a result. So that has come into accumulation towards the end of the month when the government postponed it by a couple of weeks. All put together, there were some issues of the kind. And that's on the top line. On the bottom line, though Thermax Limited has reported a better profitability for the Q4 alone by approximately 100 basis points. At the group level, I had some difficulties, especially Dan Stoker, our European subsidiary, only for the quarter had a negative, putting it to such a level that unexpected level. That's only cost overruns of a one-of-a-kind for the time being, and I don't think it is going to be repeated for the future quarters. And next was our Chinese subsidiary, certainly was expected to be in losses, but we had some litigation for which we have taken a prudent position of providing for it. So a couple of these issues put together, we've had some difficulties on the profitability on the group side. Otherwise, it is not such a bad quarter, because if I go to look at my order intake for the quarter is also kept in line with, despite the industry not doing too well in terms of order intake in Q4, I had a fairly large 40-45% improvement in almost 50% improvement in the Q4 order intake, which really pushed the order carry forward. I'm entering the year with around 5,700 crore worth of orders, which is 43% more than what we had in the previous year. And these are all very solid orders, and I don't expect anything to go wrong in execution. So I'm looking forward to a better year. And plus, we have also provided for a certain amount for impairment of assets in our Chinese subsidiary, because going forward, we don't think that we'll be able to sell, looking at some of the local, I mean, let me say that the local conditions for an Indian company to be operating in China, it has had some amount of a tailing effect or a deterioration in the recent past, though things may improve going forward, but we want to be very cautious on that. So a provision is already made on the count, and a very small amount of maybe a 5 crore provided for the SPX joint venture, which we are on the verge of buying of the shares from the current owners. So those are the kind of negatives which are, see, we are a very prudent company. We don't want to wait for the event to happen. We do provide from the balance sheet, which could have had a telling effect. But overall, if you look at it, Neeraj, ultimately for an investor, my EPS is better than the previous year, despite the top line and bottom line being lower. Earnings per share has gone up by around 3.5%, 3 to 4%. We've been able to improve on that count.
Yeah. No, I mean, I think the standout, Mr. Unnikrishnan, to my mind, is the consistency in the order book or the order inflows that you've exhibited for almost each of the quarters since quarter 4 FY17. The only doubt before I move to the future would be, or not a doubt really, but a question would be, why is it that the operational performance also weakened? Is it largely because of the lack of execution of the top line, which resulted in the EBITDA numbers looking slightly weak because the expenses, the fixed expenses would have remained constant? And will that correct itself in the quarters ahead immediately?
Yeah, that's why I mentioned about, see, predominant part of the turnover for Thermax comes from Thermax Limited balance sheet, which is reported a 1% or 100 basis point improvement in the EBITDA at a lower turnover for the Q4. So going forward, ideally, the asking rate in the last quarter, with the kind of orders that we had, as I mentioned about, could have been at 10% more, upwards of maybe near to 1,600. At that level, we would have certainly reported a even higher profitability, profits, and every number would have been, which we were unable to do in the quarter, but this is only a one-off. And with the carry forward or orders available and the markets looking quite positive going forward, may not be positive everywhere, but at least in the markets that we operate, looking positive, we should be talking about a substantially improved top line for the next year, quarter over quarter, which would also translate into better profitability in the next year.
Would northwards of 15%? Just trying to get a gauge, really, not asking for an exact number.
Are you talking about the top line?
Yes, I mean, you mentioned substantial top line. I'm just wondering, what do you mean?
A double digit certainly should be happening, could be even the number. See, normally as a practice, I don't have a habit of giving a guidance on top line or bottom line. But you can certainly gauge it from the kind of order which has come in, a good part of which has got to be revenue recognized in the coming year on contractual commitment to the customers itself. So that's, I mean, unless some customer will have to let me down, which doesn't happen, because we are very clear about most of the projects which are under execution, and we are very in close touch with the customers, and things are moving properly. Let me say that much at least.
True. You know, I remember a conversation, Mr. Unnikrishnan, maybe 3 or 4, couple of quarters ago, not 3 or 4 quarters ago, really a couple of quarters ago, wherein you had mentioned that while manufacturing is looking up, you are in a better position compared to some of the peers because of your international exposure too. How has the performance of the international subsidiaries been? One, the reported performance. Two, what do you think the performance has been, and how would FY19 turn out to be?
If you look at barring the Chinese subsidiary where we had challenges related to the local market difficulty, I do not want to blame anybody, but certainly the country-to-country relationship would always have some ramification in a country like China, especially when you're wanting to do local sales. So we've taken a corrective decision that going forward, at least for some time to happen, we will be utilizing my Chinese facility only as a manufacturing place, and we may desist from selling in China for some time till things do improve. And on that count, then it will become something like a manufacturing center rather than something which will be operating independently. That's about China. Otherwise, Danstoker group of companies, including what we have picked up in Poland with the new setup that we have already created, we are offshoring a part of our manufacturing from a very expensive Denmark into Poland, which will start happening from the current quarter onwards, Q1 onwards. We should see an improvement in margins for Danstoker Group also, because Polish manufacturing expenses are almost closer to what we do spend in a city like Pune, not more than that. So where in comparison to Denmark, which is much more expensive. So that is one of the ways by which we'll be able to improve our margins in Danstoker Group. So Europe should do better. And our Indonesian subsidiary, the first year of operation is going to really happen only next year. The current year, we would have booked the expenses as a revenue expense in the balance sheet of the company. But in next year, there will be at least a reportable quantum of income coming from the Indonesian subsidiary. And as it picks up, certainly the global performance of the company should improve. That's point number 2. And third is we've picked up fairly good number of orders in the international market too in the current year, including the first ever coal-fired power plant order that we picked up in the 2 quarters back from the United Arab Emirates. It's proceeding quite well. And that will be a precursor for solid fuel combustion projects that we can look forward to from both Middle East and Southeast Asia. And though not reported, we picked up a couple of orders even from the Southeast Asian edifice for medium-sized captive power plants. So the outlook as I'm moving forward for the international market looks okay. And Neeraj, another very important factor that I need to be taking into consideration is Europe is not the Europe that we looked at maybe 3 years back with a lot of skepticism. We are seeing an overall improvement in the European, main European economies. Barring 1 or 2, most of them are growing between 2 to 3% versus the negative growth that we witnessed maybe 3 to 4 years back. So my European operations as well as my export into Europe for the larger projects should improve also going forward.
Is this a phenomenon that could last for a couple of years out or maybe longer, Mr. Unnikrishnan, Europe and the contribution that it can give?
My take is the markets that we are operating is already bracketed on.
Okay, there are fun things that can happen in a digital interaction, but I think I just interrupted, that music just interrupted Mr. Unnikrishnan's discussion. If I can request him to get back to that question. And Mr. Unnikrishnan, what I was trying to ask you was whether this performance in Europe can extend itself. Okay, I think we'll just get in Mr. MS Unnikrishnan in moments from now. Keep in mind, the one thing that, two things that I want to know from him, if time permitting, because we also have another discussion lined up. Two things that I want to know from him, time permitting, is one, whether this recovery that he's speaking about in Europe, and he's saying that it's a different Europe than what he's seen in the previous past, whether it can extend itself into not just the next couple of quarters, but maybe 2-3 years. Does he have that vision or belief? And two, their working capital cycle decreased from 39 days in FY17 to 15 days in FY18. What's led to this, and will that augur well for Thermax going into the whole of FY19? The stock may be reacting down today, but this is honestly a quarterly interaction. Whatever I make of this, the valuations notwithstanding, whatever I make of the conversation that we've had thus far with Mr. MS Unnikrishnan, he firmly believed that Q4 was an aberration. Things will pick up immediately starting Q1 in FY19 itself. Okay, do we stand a chance to get in back, Mr. MS Unnikrishnan? Okay, I think it'll take some time, so maybe we'll try and take the queries from him offline, and you can hear out this whole interaction and the full piece of what Mr. MS Unnikrishnan was trying to say on BloombergQuint.com a bit later on as well. So for all of you who want to hear more about this discussion and what Mr. MS Krishnan would have said, in about half an hour's time from now, you'll be able to hear out something like that. Let's move on to the next discussion as well. We've about 8-9 minutes left on the show, and that's the impact of what the JDS and the Congress combine has done in the state of Karnataka, the impact of that on the political front, and how would the markets watch the whole of this thing. Somebody who tracks this piece very, very closely, Tirthankar Patnaik, he's strategist at Mizuho Bank. He joins us right now on the show to talk about that. Tirthankar, really appreciate you taking the time out and speaking to us at Bloomberg Quint. From an investment perspective, what's happened in Karnataka, does it have meaningful ramifications, if not for the immediate 1 month, then over the course of the next 6 to 12 odd months?
Well, I guess a couple of things were clear after the Karnataka verdict. One was Prime Minister Modi's presence in campaigning does have a significant impact. So, his presence, his speeches did have a significant impact on the BJP's performance in Karnataka, and Prime Minister Modi remains a fairly important factor going into the 2019 elections. That much was quite clear, first in Gujarat and secondly in Karnataka as well. The fact that the final verdict did not work out in favor of the BJP would be something of a roadblock for the market. It will be a wake-up call that one could expect a significant move into a full-on political mode for the country going into 2019, and it has definitely rejuvenated the opposition, and one can therefore expect from a market's perspective political angles to be really important in the next couple of months, and that is something that we are watching fairly closely. What the market can possibly take heart from at this point is that BJP did make significant inroads in the south. It did come fairly close to getting power in Karnataka, and the fact that it remains a fairly powerful force to reckon with in going into 2019 and going into the couple of elections that we are seeing in the rest of the year. And the added icing on the cake, of course, is you get one more seat in the Rajya Sabha.
Okay, interesting. Would you fear, Tirthankar, and of course things can change, so nothing that you are saying right now is cast in stone, obviously, but would you fear that there could be more populism politics from now until the next 3 state elections?
Well, this has been a question that's been asked, since the large budget last budget was posed. It was asked again when the borrowing calendar was released for the first half. Clearly, looking at both of those macro events, one saw significant restraint on part of the government towards, against populism. But given the adverse outcome, I would say, not the adverse result, the adverse outcome in Karnataka, one could expect a little more move towards populist policies. One saw that in the short-term tenor of the BJP government of one day, where a farm loan waiver was considered. So from the state government's perspective, particularly if the lot of the farmer does not improve significantly, particularly if some of the promises that were made by the central government in terms of an MSP hike do not pan out well in terms of helping the agricultural sector, one could expect more populism, one could expect a little more laxity in terms of fiscal prudence by center and state alike. Our base case, however, remains that of significant constraint on the government in terms of fiscal numbers. What we are worried about, not so much right now in terms of fiscal laxity for elections, is what to do with crude. If crude continues to remain around $75 odd, then the entire calculation for the fiscal could change in a pre-election year potentially.
Yeah. So Tirthankar, and my worry is not as much, I mean, where my question was stemming from was the fact that, the SP-BSP have made noises of joining forces for the Lok Sabha elections. We've seen what joining forces between Congress and JDS could do to BJP as well. And maybe they would be very, very wary of what all of these things would mean for 2019, and therefore would they resort to populism in order to thwart that. But okay, I think you bring out a larger point, and that's my question to you next. So then from a market watcher's perspective or a strategist perspective, would you believe that because of the macro being the way it is, never mind the fact that the micro is showing the signs of improvement, because of the macro, both political and otherwise looking the way it is there a near-term cap on the upside for the markets?
There's clearly a near-term upside. We saw the markets weather a fairly bad February and March, and then we saw a revival of sorts in April. But May, things have come home to roost in terms of crude, in terms of higher inflation, in terms of depreciation on the INR, and on the current account deficit, which for this year could be around 2.5%, but for next year could shoot fairly close to about 3% figures. So as you rightly point out, from a micro perspective, the earnings figure for FY18 was about 2%. FY19, FY20 consensus earnings are currently expected to be around 20%. So there we are clearly seeing signs of recovery. But the macro overhang, something we had not seen for the last, almost since 2013, is coming back to haunt us. The key question for the government, again, in a pre-election year, coming back to the political side, is whether the rise in the current account deficit would be allowed to move into the fiscal deficit as well. One of the issues that we've always had on high crude is government's reluctance to pass it on to the consumer, to allow a natural adjustment to take place. In a pre-election year, if the government really develops cold feet in terms of allowing high crude prices to go back to the consumer, then this current jump that we are expecting in the current account deficit could find its way into the fiscal deficit as well. And that will be definitely an overhang for the markets. In the near term, clearly macro concerns rule right now. We would definitely see the central bank now looking at a rate hike. That's again not going to help from the equity markets perspective at least.
Yeah, that was my last question really. With crude doing what it is doing, and if indeed rates move up because yields move up and the chicken and the egg situation, could that come back and impact the 18 to 20% earnings growth that people are talking about? Because hitherto people have not factored in the worst for FY19, the worst macro. Could that bite or eat into the micro as well for FY19, Tirthankar?
No, very fair point. See, when you're looking at FY19 numbers, you're looking at about a 20% odd growth. You're looking at a significant improvement in financials. Now, financials are contributing pretty much half of the incremental profits that you would see in FY19. Followed afar by the commodity complex, which is oil and gas and metals in our understanding. Now, if there is a significant move up in domestic cost of funds from current levels, then the anticipated recovery that we are seeing in the asset quality issues and thereby the rise in PSU bank profits may be extended by a couple of quarters further. That would be a worry. On the other side, the balancing act would come from sustained rupee depreciation, which should help realized earnings of the IT sector, which should help realized earnings of the pharma sector and to some extent for metals as well. My sense is that if there is sustained macro depreciation, macro deterioration, one would look at a downward revision of FY19 earnings as well. This should be not a surprise for us, really. In the last couple of years, all we've done in terms of consensus earnings, we've seen that we begin the year fairly, fairly optimistic, and then we have a reality check about a quarter or two down the line. This year, thanks to the macro, that reality check might come out sooner than expected, but we would still expect about 15% earnings from a conservative side for FY19. FY20, repeating a double-digit figure would be a significant sign that the macro recovery has indeed found its feet.
Okay. Tirthankar, really appreciate you taking this time and joining us and speaking to us. Thanks for talking to us today. Well, that's the view from Tirthankar Patnaik of Mizuho, and his thoughts on the macro versus the micro. Certainly seems to be a bit of a worrying situation. The market's lying flat right now. The Nifty bank up about 0.25% higher. UltraTech Cement, the star of the morning, at least on the large cap front. But a lot of losers at the mid cap end. So keep that at the back of your mind. Wrap it up on this leg of Indian Open. Up next is the FNO show. Stay tuned to Bloomberg Quint Live.